Good morning, everyone. This is a very special Hot Take of the Day podcast. I am coming to you live from Austin with Todd Brooker of Cawley, Gillespie Associates. And I bet you didn't know how exciting and how much you were looking forward to a podcast on reserves. Todd, I know you've been very much looking forward to this. I mean, SEC reserves, we're going to go deep. Welcome to the show. Thanks for coming on.
Thank you for having me. I'm very excited to be talking SEC reserves, and anything you want to go through, I'm happy to go through it because it's all about educating everyone.
Absolutely. So, I mean, I think the question that everybody is already thinking and needs to know the answer to before we even get started, why are the hotel rooms in downtown Austin so expensive?
Well, I can ask you, why are they so expensive in Denver?
Oh, that's true. It is true.
Same reason.
It is true.
People come to this city just like they do Denver.
They do. I found myself staying at a very, very nice Crowne Plaza last night, well out of town. Anytime I find a Priceline deal for less than $100 on a hotel, I'm going to take it, even if it takes me 30 minutes in an Uber to get there, because I don't want to spend the money.
You did good if that's all you spent.
Exactly. So let's start with really. So we're deep in SEC reserve season, and walk me through a sort of hypothetical company process. When do you get engaged? The number of years you've been working for them, and then the kind of dialogues you have with the companies as you build up to your final report and what they adopt to report to the SEC for those listeners who don't know. Sure.
Well, we are deep into it. We're almost at the end of January. Vast majority of our public clients have we're complete or completing their reserve reports. Some don't file until February, so those are still ongoing. Depending on the size of the company, we might start in October, but usually it's November. You start kicking off the process, and then we're deep into it. December, we get to work during Christmas and New Year's, which is great, and then it carries deep into January for long hours, weekends, nights, and into February. So January, February are very time-consuming for us. It eats up a lot of man hours. People are working 100% plus. Everyone's busy. There's no downtime. But usually the process starts with some phone calls and then maybe some face-to-face meetings, talking about what happened during the year, giving us an update as to what changed, assuming we've worked with them before. And so it's from year to year to year. It's more about what changed during the year.
Right.
What are your go-forward plans? And so we try to be efficient, narrow down what those changes are and what their go-forward plans are, and focus on those. Year to year, most things are pretty consistent. The well keeps producing. You advance the forecast forward a little bit, and you may have some operating cost changes and some tweaks here and there. Prices change, those kind of things. But for the most part, it's a lot of it is similar year to year to year. So we focus on the big ticket changes.
Yeah, and I think that one of the points that you made is really, I think, probably the most poignant, is that things don't really change in our industry that much. Maybe you have some acquisitions, maybe you have some divestitures, but you're really, especially if you've worked with a client for a long time or you've been in that basin for a long time, there really doesn't change that much year to year. You maybe pace of development, costs. What have you seen over the last 2 or 3 years that have been the biggest changes, whether it's capital or LOE or well spacing? Like, how would you characterize the biggest change from reports 3 years ago to reports today?
Well, that's a good point you bring up. I said a lot of things don't change. I'm really talking about the producing wells. Mm-hmm. Those wells continue producing. What has changed every year for the last 10 years in every basin is how you manage the upside. As you know, we decided to go from vertical to horizontal drilling. Massive change. We decided to do large frac jobs, which created a lot more opportunities to pull oil or gas into the wellbore and create much bigger reserves. On top of that, you think about you have companies that are pushing the envelope, some that are very aggressive in their frac jobs, some that are very non-aggressive in their frac jobs. They're very cognizant about, okay, I don't want to frac into my neighbor, and so you've got within a field, you've got 10 operators, and every one of them has their own recipe.
Right.
And
their recipe is always better. 10 people have the best recipe.
Exactly. And but it makes our lives difficult because, hey, can you give me some type curves here? Well,
right.
I know we're only looking at a township, but I got 10 operators with 10 different philosophies, and it's very difficult to do that. And so it takes us a lot of time to do reserves, especially with a company with assets in many basins.
So I want to start on the frac design. Do you see? I have been on record saying I really think that sort of 1,800 to 2,200 pounds per foot is probably correct. That 2,600 pounds, 27, a lot of the bigger numbers, which I'm sure you've seen, are fracking a much larger area. So maybe in a standalone well, you're draining a larger area, maybe.
Right.
But generally in these tight spacing, you don't need that big a frac, and that we're making high IPs. That's my soapbox. How do you factor in somebody does 1,800 versus 2,200, and how much conversation are you having with companies around like optimization? Are people aware of it, or are they sort of, well, we're at 2,200, and if we go to 26, we'll get more, and you should really give us more reserves? Where have people come on completion design? Yeah, I see. I hit a nerve there.
Yeah, you did. We spend most of our time dealing with that issue right there. Companies do spend more capital to put more sand in the ground, and so you want to give them the benefit of the doubt, or you want to give them credit for it because they're paying for it. But can you justify it? Yeah. And so this gets into the issue: is are we booking proven reserves, and what is actually proven with that advance in sand content or fluid content or whatever it is. So we'll spend a lot of time trying to analyze the data, and can we see differences in that uplift that they're asking for? And sometimes you can, it's very clear. Sometimes it's a mixed bag. Most times it is a mixed bag. Yeah. There's the good, bad, and the ugly, and no one wants to focus on the ugly. But when you do a type curve, you're supposed to be taking into account the good, bad, and the ugly. But when you filter out all the ugly, and you filter out mechanical issues, and you filter out other, sand volumes or fluid volumes or whatever you're filtering, you can end up with a high-graded set of wells that may not really represent the average well you're going to be drilling in the next few years. So, again, we wrestle with that topic every single day, and in some cases we don't agree with the client, and in the end, it has to default to what Cawley, Gillespie, or the third-party consultant is willing to book. But usually you can work through it, and it's just an educational thing. You have to let them know, I hear you, I see where you're going. I hope you hit these numbers. But right now, at the proven level, we're 15% below. Right.
And so let's take a step back, and no podcast is going to be complete until we talk about smog, obviously. But
what a great name! It's one of the greatest tools you have to evaluate companies, and it's called smog.
I know it's a pretty ridiculous name, and the fight continues. What about SEC reserves? Talk to me about the categories and certainly how you slip between proved, probable, and possible, and how things are moving. But give the listeners just a quick overview of the different categorization of reserves and where you focus most of your time.
Okay. Well, most of the time we're either doing an SEC report, which or a NYMEX or strip price-based report. But in general, the reserve definitions that we use for those reports are the same, whether it's an SEC report or an SPEE PRMS report or a Canadian, report. The reserve definitions and the guidelines are pretty much the same across the board when it comes to reserves. Now, the SEC does have a couple of big caveats. Hey, you only have 5 years to drill this well. If you don't drill it in 5 years, it's really not reserves. SEC, the way the rules are written, it needs to be moved out of reserves altogether. But most people will take a PUD and downgrade it to a probable if it doesn't get drilled in the 5 years. But I'm kind of getting ahead of myself here. Let's talk about the categories. Yeah. So we normally focus for public companies on proved reserves. Don't normally focus on probable and possible reserves, which have a higher risk element to them. Maybe a further step out from existing production. Maybe that there's some uncertainty associated with it. But proved reserves, basically the SEC says that they have to be reasonably certain that you're going to produce those volumes. And
that's sort of like 90% more likely to go up than down over the course of time for a given proved reserve.
That is exactly what it is. But it goes back to, are you doing reserves deterministically or are you doing probabilistically? Most of the reserve work that we do is deterministic. When you do deterministic, they don't really say it's 90% certainty. It's reasonable certainty, but they're implying 90%. But in reality, there is wiggle room there.
Yeah.
And one thing that bothers me about people that pound their fists on the table that it has to be a 90% probability of success. Yeah, I hear you, but in our world now, with drilling thousands of horizontal wells a year, we now have critical mass, and we have a lot of data points. So we're at a point where it's shifting towards a P50. Not that that's the right answer, but you'll see a lot of P50 booked as proven reserves.
Right.
Because theoretically, it should approach that, with
over the course of time.
enough data points.
So I mentioned smog. So a company comes out, they meet with you. They give their view of their reserves. You audit their reserves, and they report, as long as you're within 10% is the threshold, as I understand it, that they are able to publish what they think the reserves are. You're probably coming in as a third party, certainly more likely to bias to a lower number. So generally you would be lower, and if you were higher, I'm sure they would move their reserves up and fire all their engineers. But separate from that, so as long as they're within 10%, that's the number that goes in their annual report. We've talked about the SEC pricing, but can you just go through the definition of how the SEC defines price every year?
Sure. Okay. You mentioned one thing I just want to say. You mentioned an audit, which is different than a reserve report. Okay. A reserve report is a full evaluation done by the third-party engineer, and it's 100% their work. An audit would be looking at the company's numbers and getting within a 10% tolerance.
What percentage of publicly traded companies that are, say, over $1 billion would be doing their reserves and them adopting your reserves versus you doing a audit and then them using their own reserves?
I would say the vast majority of the work that we do, it would be reserve reports versus audits. But the bigger you get, the more you're going to shift towards audits. Right. It's just impractical for certain companies to do a full-blown reserve report. It's very expensive, time-consuming,
But so in sort of a small to mid-cap world, so in $1 billion to $10 billion, most of the reserves that you're doing are reserve reports where they are publishing your number as the smog, whereas companies who are perhaps over $10 billion, massive companies would be doing, you'd come in and audit their numbers, and for obvious reasons, it's just huge. So is that a fair characterization? That's correct. It doesn't mean that we won't interact with the company and work with their reserve engineers and work together to get the reserves where they need to be. On a reserve report, but again, it ends up being an independent third-party reserve report versus an audit. But regarding the SEC prices, so in late 2008, early 2009, the SEC changed some of the guidelines that we follow, and one of them was the price deck. Prior to that, we used the last price at the end of the year. So December 31st, what's the closing price? I remember that. Oh, it was the worst. There'd be some crazy event like a missile crisis or a coronavirus, and the price would go crazy. Yeah. And if it went up, you were so happy, and if it went down, you'd lose half your reserves. It was insane. I couldn't believe it. Yeah, and it was insane for our clients as well. It just wasn't right. So they did make a good change, and basically it's an average of the last 12 months, but they take the first day of each month over that 12 months and come up with a straight average. And so it's a little better judge of future prices, but as you know, you can have spikes at the end of the year, and the go forward strip might point to much higher, but currently it's not that way. It's just interesting what's going on. Prices are all over the place, but we ended up at $55 oil. And 267, 257 gas? Yeah, 257 on gas. This year, and both are down from last year, and we know what's going on right now with gas. It's down, oil's down as well. So there's always going to be a disconnect between the SEC year-end price and the go forward, but it's just really, really challenging right now to predict what's going to happen. So I don't predict oil and gas prices. I've been doing this for 27 years, and I've been wrong most of the time. Are companies able to include their hedging in? So if they have, the SEC mandates a price that's 55, and let's say, congratulations, Oxy, have to give a little shout out. When things went up January 2nd, I think the Oxy was one of the more active hedgers. Again, I wrote a post on it called, I think, over under the hedge, and said that any producer that hedged the day after the Iranian missile assassination was really smart, and Oxy did that. But on that note, can companies factor in a higher price if they have 2 years worth of hedging that might change economics? Can that be baked into a reserve report, or is that a separate line item that's outside of the mandate?
It cannot be in the reserve report, in an SEC report. Now we will publish 2 reports for a lot of companies. One will be SEC, one will be a NYMEX strip price deck, and you can include the hedging there, and we often will, but for reporting purposes to the SEC, it can't be included.
How about over the last 18 months, let's say, what have you seen in terms of capital? We hear a lot about capital coming down. The service industry, the oil field services have just been getting crushed. Not only is activity lower, but pricing has come off a lot. What are you seeing in your clients from a CapEx or an LOE basis? How much, dollar per month of wells for LOE and how much capital has come down as a percentage versus maybe reports you did last year? Is there a number you could guess?
Wow. It kind of is all over the place. Again, we do public reports, we do private reports. And in the public reports, an officer of the company is required to certify that the AFEs are current and they're accurate. And so they're typically pretty updated and would include any of the changes they're seeing in the fields. They're always renegotiating where they can. And, the poor service companies are just getting pummeled right now, and it's a difficult time for them. But we're also doing private reports, and sometimes it may be a non-op situation where you just don't have good AFE information. So we're searching around for the data just like you would when you're trying to figure out what the economics are on this well. But as far as capital this year going into year-end 19, I would say from year-end 18, it may be down 10%, maybe down 15%, but I don't go gauge it across all of our clients.
Right.
It's almost impractical. Truth be known, I only work on what I get paid to work on.
Oh, yeah. What is that? That's so crazy to me.
But if you want to hire us to do that, I'd love to do that for you.
Yeah, I love it. So I mentioned smog before, and we connected on LinkedIn. We've been friends for a couple of years. So you've seen the criticism. You've seen my advocacy for this as a method because. Again, to reiterate, yeah, sure, I could guess the type curve, and I could guess the inventory, and I could guess the working interest, and I could guess the CapEx, and I could guess the LOE, and then I could build some crazy Excel model and say I've valued the company better. Or I can use your reserve report where you actually have those real numbers, where an officer actually certifies what the CapEx is. You go through a 5-year development plan, and that becomes the reserves. So that's the basis of why I use smog versus some other model. What do you think is the biggest risk that I have, or that anyone using smog would have by adopting that as a number every year through reserve fluctuations if we exclude price? Because obviously if price goes from 63 to 55, things are going to change. But on everything else, what is the biggest risk or downside of using that methodology, knowing what you know about SEC reserves?
Well, I will say we have such a spread of SEC clients that some behave very conservatively, some are a little more aggressive, and so their reserve reports will reflect that. They typically drive the train when it comes to here is our development schedule. We can guess what their development schedule is, but it's really up to them. They have to say that yes, we've green lighted all of these drills. This is our plan going forward, and so if we can get that into approved reserves and everything smells right, then we'll book it. But some companies do book conservatively. There's a lot of sticks that may not be in that smog evaluation that you're looking at. So you could be undercalled there. There are some that are definitely could be overcalled. Maybe they've carried some PUDs to year 4. They're getting close to expiring and you don't know that. Or maybe you do know that. But somebody like you that's really smart, you probably do know that. But
right.
There are some that could be expiring. But the one of the biggest concerns I have in using the smog is that I guess hard to explain. Not all reserve reports are created equal,
right?
And you have to know a lot about the company, and
Yes.
Go ahead.
Yeah. So you're thinking, so a company comes in and they're going to be super aggressive booking PUDs, and certainly there are companies, and I would use Pioneer as an example. Certainly they underbook PUDs. I don't know what the percentage is exactly, but they basically have no PUDs. It seems like whatever's PDP, they kind of book it, and then they're sort of like, whatever, just trust us. There's other companies that you're saying would be super aggressive. Now, would the SEC allow me, if I'm running 2 rigs today, to say, well, I'm going to go to 7 rigs next year, so let's put everything in? Or do they mandate like a flat, like the games that you can play? How aggressive can companies actually be? Because, I'd like to think that on the one hand, a company is booking everything, so it's never going to be better than the smog, but that's what I think I can do for 5 years. Then there's other companies that are like, well, I only really want to book 2 years, and I don't really care about this, and so I'm just going to ignore it. So theoretically, that maybe they're undervalued relative. But what games do you see people play in terms of aggressive? And certainly I won't make you comment on them, but there's been some Chapter 11 circumstances where, people have pointed on Twitter that a reserve report is really, really great, and then a year later it's like totally trashed. What kind of games are people playing?
Well, you named several of them. Playing with the rigs could be a game, but I will say the SEC has done a pretty good job in the last 5, 6, 7 years of upping their game, and they're laser focused on companies and their capital availability, and that the wells that are in the reserve report, the drills in particular, that they've been green lighted by the company. And I don't know of any companies that really have green lighted wells 5 years out, right? But but they want to make sure that not only is the reservoir consultant looking at the company's financial capabilities, but the company is as well. And even if they haven't really green-lighted that well out in year 4 or year 5, are they set up to where they could do that? I mean, so if it's impossible, then don't book it, is basically what the SEC. So they're laser focused on that to make sure that you have the capital, or you will have the capital to drill those wells. But you can play with the rig count, and
so you could escalate rigs.
You can escalate rigs, but the SEC wants everything to be reasonable or reasonably certain. And let's just say company X has in the past got up to 5 rigs. They're currently at 2. Is it reasonable that they could go back up to 5? Well, it is reasonable, but if they're relying on prices, the strip, the futures to go up, then they can't do that. The SEC doesn't allow companies to say, well, we're going to do our development here in the SEC report based on futures. It has to be based on current conditions. The SEC is very clear throughout their rules. It's based on current economic conditions, and often companies kind of get in a little bit of trouble for that, because they'll talk about it in their company 10K, or they'll talk about it online, and they'll kind of trip over that and say, well, the forward curve is what we're using, but
they can't.
They can't.
So if you were the SEC, if you worked there and you were in charge of compliance for oil and gas companies, and you wanted to minimize some of these games, or what is there some tightening up that you would do to regulations, or are there some changes, or do you think that really that the changes the SEC's made in the way that they've adapted the horizontal wells, do you think they're doing a good job on that?
Well, yeah. I mean, it took a while for me to get comfortable with the changes they made in late 2008, but they had to. I mean, the world had changed. You were having hundreds and hundreds of horizontals hitting, and you had spacing rules that were just not very flexible for anyone to get a well drilled. I remember, personally, this is in 2010. The old rules from the SEC said that you cannot book a PUD unless the location is legal. So let's just take North Dakota. North Dakota has the drilling units and the DSUs. And at the time when development first started, horizontal development, you could only drill 1 well per DSU. It had not been downspaced yet. So it was illegal to book a PUD next to that producer based on SEC guidelines. And so I remember having conversations with Ron Winfrey and some of the SEC staff, and said, look, guys, my hands are tied here. These are legit PUD locations that are reasonably certain to get drilled and all that. And they go, okay, book it. I'm like, well, wait a second. This is an illegal location based on your rules. They go, well, use the reasonable certainty rule. And so I've tried to apply reasonable certainty to just about any decision that I try to make on an SEC report. And it's very important that, I mean, that's probably the single biggest term that you see reflected in SEC guidelines, reasonable certainty. And so once we found out that the SEC says, well, yeah, our rules do say it has to be a legal location, but when I looked at the NDIC records, I found that 99.6% of every single downspacing request was granted.
Right. That's reasonable certainty.
That's reasonable certainty, and
right.
They said then you can get book it. So it opened up the world of booking PUD reserves for horizontals in all the basins, and it was a great thing. But it also went too far, as you know. I mean, there was lots of overbooking from certain companies.
And would you say overbooking when you talk about that? I mean, is it primarily the downspacing that people have assumed that you could put too many wells in at too high a type curve? Would you say, is that the overbooking?
So there's two rounds of overbooking in my view. And back in 2010 and 11, when the SEC rules changed, it was interpretation issues. You had companies like Cawley, Gillespie, or any of the other, or the oil and gas companies. They were interpreting the rules in a certain way. Hey, I've got to stick here. Over to the east, I've got to stick there. There's no reason I can't put 22 PUDs in between. You know, I've got geologic continuity. I've got production and production east and west. So that was some of the early overbooking, which a lot of companies took massive write-downs, and long story short, the interpretations have changed, and the SEC has spoken more about it, and people, I guess, became more reasonable and realistic.
Right.
And the latest rounds of overbooking, if you want to call it that, is just, you know, stacked pay, getting as many sticks as you can into whatever acreage you have, and price would drive, you know, more sticks, you know, tighter spacing.
Right.
And as price comes down, it upspaces. And so that's what's happening right now. We've had prices that have just kind of fluctuated and stayed, you know, fairly mediocre. And so you do have upspacing going on, which I personally feel like is a good thing, because you clearly see interference when you get depending on the basin, but when you start getting below 1,000 feet between wells, you know, you need to your radar needs to go up. And when you get down to 500-foot spacing, you really need to start paying attention.
Right.
And as you know, there were some people drilling even closer than that.
Yeah.
But so anyway.
Yeah. I think that's a good rule of thumb for people. And again, it's hard to have total transparency in line of sight, but I agree with you. I think 1,000 feet between wells, certainly in the same bench, I think is you know, tighter than that. You probably have to be paying a lot of attention, and really there's been thousands. I mean, I think in 2019 I think we had 14,000 wells completed horizontally in all the basins. So it's not like we don't have the data to sort of see what happens, and someone has tested a spacing within 15 miles of where you are that is probably too close and that you can validate.
Right.
Now, I don't know that you saw I want to say it was probably August, Tudor Pickering came out with a report, and it was one of the first and deepest analysis I've ever seen, certainly on the Permian Basin, in terms of parent-child, and that you'd have a well, and their assessment was sort of if you had a well that was fully draining its surrounding area, and you drilled a well after 12 months past it, they were seeing as much as 40% interference, is what I recall. That certainly moved companies to, okay, once. I think there's a company I know of in the Delaware that calls it lighting a fire. Once you've lit the fire on one well, you better be marching forward. How do you factor in parent-child and come up with a good assessment of that? And do companies, when you come back and be like, I think it's a 40% knock, do they widen their spacing, or what have you seen from the parent-child world in the last 6 months?
Great question. We could talk hours about that, and so that's part of the complexities of doing reserves. It's a difficult situation that we find ourselves in, and trying to analyze that, because that parent well could be 6 months old, or it could be 3 years old. And in some of the evaluations we do, we don't always have the perfect set of data. You know, we don't always get pressures, and we don't always get extreme, but we'll just see production data, and it could even be allocated production data, which could be tricky in itself. But So yes, we take into account parent-child relationships, and we try to see, is there enough information here that we can glean something out of it. It's time-consuming. It's expensive when people hire us to do that, because to do it properly, you need to know what the spacing is on every single well at any point in its life. And we've got some products that we use here that help us figure out, okay, what is the spacing on the well, what is the timing, and what do the reserves look like now? What do they look like before this well might have been impacted by a child being drilled next to it and things like that? So we try to take into account, but sometimes you just have to kind of use rules of thumb.
Yeah.
And I read the report you're talking about by Tudor Pickering Holt, and it was excellent. But I was glad to see it, because that's the thing we face and fight most often. One of the big problems, though, David, is that when you're looking at parent-child relationships, the problem with the child these days is that 4 years ago it may have had 500 pounds of proppant. Move forward each year, it goes up to 1,000. Next year it's 1,500, and next year, in some cases, it's 3,000 pounds of proppant. And so what happens is that child could come out of the gates with fantastic IPs, and reserves look like they're whole. Wow, we're as good as the parent. And so there's complexities there in sorting that out, because every year they keep changing the recipe on us. So it makes that analysis very difficult, but we try to take it into account. But again, sometimes rules of thumb are the best thing, because unless you have downhole gauges and you're measuring things like measuring pressures and looking at PVT data and maybe doing some rate transient analysis, whatever that is, if you've got time to do that on every single well in a 6,000 well reserve report, good luck. I mean, it just doesn't happen. And so we're usually moving very fast, and we're trying to use rule of thumbs to get us through it. But parent-child relationship is the big term you hear thrown around quite a bit now, and it's a complex relationship.
So I want to touch on you mentioned IPs. IPs, I think, are just the absolute stupidest thing that our industry does, that we announce some IP and have some expectation that this means something. And I have been on record, and I say it all the time, that the increasing IPs are actually not changing EURs. And so, again, I know I'm being general, and different basins are different, but would you agree with that statement that we've really pushed these massive IPs, and that ultimately we haven't really changed the recoverable resource of that well? Or would you say that you are seeing a correlation that substantially higher IPs are leading to higher EURs? And again, people will talk time value of money, and I've done a lot of posts on that I think people are misinterpreting the time value of money. We can talk about that maybe, but let's start with IP. Do you see a correlation to increased EUR at this point in the cycle?
Tough thing to answer, David. So I agree with you that pushing IPs higher doesn't necessarily lead to more reserves. There are circumstances where it clearly does. If you're talking about normalized lateral, if you got a whole subset of 5,000 foot laterals, and you have some that had a higher proppant amount or fluids and higher IP, it could lead to more reserves. But again, it goes back, is this a parent or a child well? I mean, is it bounded or unbounded? Where are you at in the field? And it's just a lot of things to take into account. But I hope that at this point that people realize that IP is not the most important thing. And I think there was a need for that back 5-10 years ago when basins were expanding and companies were trying to get their name out there. But the highest IP is not real healthy for a wellbore. I think if you spend $6 million on a stimulation job and you put all that expensive sand in there, I don't want to destroy my perforations by pulling the well as hard as I possibly can and gumming the well up and creating long-term production issues, and you're not going to hit your EUR targets. I do think there's some merit in slow backing the wells.
Yeah.
And I'm hoping that companies would follow that more. It makes it more difficult for us, because when you slow back a well, you can't really see the decline and the well behavior if that's all you're doing is DCA analysis. So a lot to unpack there.
Yeah. I won't mention specifics, but we've certainly seen some pretty high-profile Chapter 11s where we've seen, I'll use Oklahoma probably as the poster child, and maybe it's unfair, but Oklahoma seems to have really moved in the holy cow, we can drill 20 wells a section, and then actually PS it's only 2. And so where you've seen that, and maybe more generally, but how did that happen? How do you go from a 500,000 barrel type curve and 20 wells in a section to 150,000 barrels and 3? How was that missed, I guess?
Good question. To be honest, we're all wrong. No matter what we publish this day, it's going to be wrong 3 days later, right? Not every well is going to behave the way you want it to. But I will say that it kind of goes back to the company. How aggressive are they? How far do they want to push the envelope? And do you have the backup data to support pushing that envelope? Let me give you an example. Let's just pick a company in Oklahoma. They have drilled 3 wells on a 640-acre unit, or 1280, however you want to look at it. But they're spacing for 8. Okay, they intend to drill 8. They tell us we're going to drill 8, so we have to go book reserves based on 8 wells. Now, it's irrelevant if it's going to be a total failure. Okay, for me, I mean, they're spending the money.
Yeah,
and they have intent. They've green lighted the sticks, so I need to put appropriate reserves. Where I find people make a mistake is those additional 5 wells to get you to 8 often are overbooked, because maybe that type curve was built off hand-picked wells,
right? And
maybe they're unbounded, things like that. You didn't take into account that we need to be booking these at an 8 sticks per mile, whatever spacing that is. So that's how it happens. And then, we've got another reservoir below us here.
Right.
And it's thick here. We're going to get two rows here. So it can happen very easily. But we haven't really talked about it much, but there's proven reserves and there's also probable and possible.
Yeah. And
so a lot of those sticks initially, let's just say you book 16 wells in a section in 3 or 4 reservoirs, some of those might be probable and possible sticks that at some point in time somebody comes in and drills one of those zones offsetting you, and that becomes proven. And so you start building on the proved reserves.
So it feels like that the best thing an investor can do is understand the smog, understand the booking, and maybe understand reserve changes through time to maybe look for aggression. Understand the balance sheet, but then in their investor presentation, if they're talking about drilling wells closer than 1,000 feet apart, and if they're talking about putting 30 wells in a cube or whatever the new fancy word is, that investors should sort of have a gut feel as to what the correct numbers are. And if they're seeing 30, they're probably not booking 30, but they're probably booking more than you would like. And it would take a reserve auditor like yourselves to be pretty vigilant in terms of going back to the company saying, well, hey, I think that the old wells were 300,000. I think because you're drilling so many, it's going to be 150. That's your number, and we're just not going to change it. So it sounds like the onus is a little bit on you all to push back on the company and be like, this is what the data shows. That's my type curve.
Right. We do that all the time. A lot of our time is sitting down with our client and discussing the SEC rules, the guidelines, and also discussing the expectations of the markets and all of our clients we work with. We have to talk people down from time to time because maybe they're new to the industry, or maybe they're a new company and they're gung-ho and they want to go book. They want to come out of the gates with the biggest reserve report they possibly can. My warning, and you and I talked about this over a year ago, is, hey, let's tread lightly here. Let's book only what you have to for now and let it build organically. People are going to offset you and help you create PUDs. You're going to drill some and create more PUDs. So be patient, don't overbook, because my game is I want to avoid write-downs. I would prefer to be writing up reserves year after year, as would the SEC.
Yeah.
And it doesn't always happen that way, but we try hard to do that. It's hard to, but when 2014 happened, you went from $95 oil down to 40 or 30 or whatever bottom you want to name. Yeah. That changes everyone's drilling plans. It changes spacing. It changes so many things. So I had a good reserve report at year-end 14, but it was irrelevant at year-end 15. You think about it. So those kind of things happen. It doesn't mean the reserves were wrong. It's just market conditions change things.
So B factors. Obviously there's terminal decline. Not a lot of wells have actually got to terminal decline. My rule of thumb, I've always used 8% as a terminal decline on a horizontal well.
That's a good rule of thumb.
And then I've used broadly, although I would say the Eagle Ford is slightly lower than this, and certainly with spacing, but broadly I've used 1.3 as a B factor that applies to the oil basins fitting the full shape of the curve. When you downspace, I would say the biggest impact is that your terminal decline is likely higher because you're having more interference. And your B factor, for those who aren't reservoir engineers looking to this, I call it the bendy factor, that the higher the B,
curvature factor,
but it starts with a B. I love B.
Okay.
But I would say a 1.3 if you're spaced at 1,000 feet might be like a 0.8 if you're spaced at 500 feet, and the difference between a 0.8 B and a 1.3 B can be as much as half the reserves.
That's true.
Do you agree that maybe we're getting too aggressive as an industry on our B factors that we're using on Parentchild, and that if we were actually more realistic, we would en masse probably start using Bs of 1 or less for wells that are drilled less than 1,000 feet?
Yes, absolutely. That's one thing. Certain basins led you down a path of having higher B factors, and that didn't carry over to all basins. And so I would say on average, most people came out too high. And if you look at type curves and you filter the wells just right, you can fit a 1.5 all the way down to a 1.1 on that same. You would look at it and you would say, Todd, that's a 1.1, and I'd look at it and say it's a 1.3, but this other company over here that wants to be a little more aggressive, they can put a 1.5 on it. So it's interpretational, but my goal whenever I'm looking at reserves or looking at Parentchild is I want to hit my target EUR, okay? If I think this is a 500,000 barrel well, and you want to argue, David, that it's a B of 1.3, and I'm saying it's a B 1.1, okay. If you want a 1.3, I'll give that to you. I can see how it fits in the data, but I'm still only going to give you 500,000 barrels. Because I've looked at the area and I know what statistics show, and so.
So you can, and again, you can manage if you know the endpoint of the EUR and
Correct.
You've looked at all of the thousands of wells that are out there, you can kind of know what the EUR per foot is, and how you get there doesn't really matter that much, except for, again, the parent-child issue where, what do you think about reserves disclosure? Do you think companies are giving investors enough information in their annual report to be able to look at this? I mean, they kind of publish the standardized measure, the SMOG, and there's the number, and then they include the letter, which is an important read at the back end of the report that you guys would provide. Do you think that they should provide more disclosure in terms of average B factors or top 20 PUD bookings or some more granularity? Do you think that they should report twice a year to have things change? Although that adds a lot of work to you, but what do you think?
Well, I know that the companies out there, they're under a tremendous amount of pressure anyway to report whatever they have to on a quarterly basis or a monthly basis or a daily basis. They're just inundated with an incredible amount of reporting they have to do. So if we're going to burden them more and have them do more disclosures, that's going to be pretty tedious. You love this stuff. There's a lot of people that don't really want to discuss B factors and discuss terminal declines and parent-child relationships and
I don't want to discuss some parent-child relationships, but in the oil and gas world, I love parent-child relationships.
Yeah, I know you do. But I guess my point is, there's so much data behind a reserve report. You're just seeing that tip of the iceberg, but below that you have just a mountain of data that we all had to go through to get to that point, and disclosing all that would be. It's impractical, first of all, but 95% of the people out there aren't going to know what it is or understand it. You would eat it up. You're like, oh yeah, finally, I've got everything I wanted.
Right.
But they could disclose more. Maybe there are a few things they could, and oftentimes you do see that investor presentations. They talk about their B factors and they talk about terminal declines, especially now when the markets have changed. They're trying to be more transparent, which I think is very good.
I agree.
Yep.
So let's pivot a little bit. We're in Austin. It's a great town. I've been here a couple times. What is your favorite golf course to play in Austin that the average consumer can play? So maybe you can't pick a private.
Average consumer, that changes everything. Austin Country Club is so nice, but that's not for average consumers.
Well, I mean, if you're going to say Austin Country Club, you're going to need to give us the phone number of a member so that listeners can go and call that person.
I can give you that.
Okay,
after this.
Love it.
I don't have a favorite. Right here close is a championship course called Avery Ranch, and I really like that golf course because if you play it from the tips, I mean, you're hitting a lot of long drives, over 250-yard carries. So it's a great, and it's a good little hill country course, a lot of creeks, a lot of lakes, and challenging.
Favorite restaurant in Austin?
Uchi, sushi restaurant south of downtown. It's one of the best restaurants in the world, in my view. I think it's number one in Austin, has been for a long time. But my wife and I really like sushi, so that's our favorite.
Do you ever go down to 6th Street? Is that what it's called? I'm always by the time I get there, I'm too drunk to actually recognize what street I'm on, but I believe I've heard that it's called 6th Street.
It is 6th Street, and we are the live music capital of the world, and that's where a lot of the live music is there and in and around it. But I attended 6th Street a lot when I was in college, but I'm 45 minutes away from there, and I'm older now. I don't care for that. I'll go down on the rare occasion. Good.
Well, I have to thank Todd. There's a big topic to unpack, and certainly he's in the middle of reserve reporting. So I really, really appreciate you coming on to talk about reserves. Hopefully, for those who are listening and have additional questions or want to dive into some reserves, please send me an email. That's what we're here for. And I think the better we can do with transparent disclosure, and I feel really happy that Todd sort of opened the kimono in terms of what their work process is. Thanks very much for listening. You can always follow us on the website at www.hottakeoftheday.com, where we have our archived blogs and podcast. That's it for now. Until next time, be good, be safe, have a great week. Thanks for joining.